makers and market movers. This is The Pulse.
Good morning and welcome to The Pulse. I'm Lizzie Burden in London. Now, the world's most valuable company will deliver its quarterly earnings report later today. The results from Nvidia are being closely watched by investors looking to gauge the state of the AI industry's massive data centre expansion. Let's bring in Bloomberg senior strategist Neil Campling for a preview. Neil, how hard is it going to be for investors to be impressed by this report from Nvidia when we know that expectations are so high? Nasdaq futures down 0.25% this morning. Does the positioning heading into this report look healthy to you?
Yeah, morning, Lizzie. I think the positioning going into the result is that, as you mentioned, it's the world's biggest company. So you probably wouldn't expect a significant move on the actual results itself. And often, actually, the realised volatility of the stock has been quite low on numbers itself. But as you say, it's really the barometer for the entire AI complex, which has trillions of dollars meaning around it. And if we look at whether it's the equity valuation is pretty low in terms of the price earnings multiple. The concern is in the other parts of the market, maybe in terms of the CDS spreads. Credit default swaps on Nvidia are higher for Nvidia than they are for the hyperscalers, which may surprise some people, given Nvidia is a cash machine generating significant amounts of free cash flow. So we're going to hear from Jensen after the numbers in terms of the outlook for the business. We expect it to be strong in terms of the absolute numbers because all the anecdotes suggest they will be. But it's really going to be about, I think as well, about the questions around that Bank of Nvidia type of issue, the circular financing, the backstopping of other deals. That, I think, could be a new area of focus for analysts on the conference call tonight. Yeah, because it's really so interlinked with other companies, but they're also kind of competing with Nvidia at this point. We've had OpenAI saying that the new Jalapeño chips it's created are better than Nvidia's when they've been tested. So as you have more of these companies developing homegrown chips, and Nvidia recently telling companies that it's going to have to hike prices, we've reported about 15%, where does that leave Nvidia? I think, again, it comes back to the overriding idea that tech should be deflationary in nature. It should cut costs. It should be, to get ubiquitous usage, it needs to be deflationary. But, of course, at the moment, we're seeing the AI costs being inflationary. They're significantly higher, particularly on the memory side. So the customers are all often going to look for alternative solutions, whether other providers or their own internal solutions, whether it's OpenAI, and we hear Amazon are doing similar, as have Google. So in some ways, Nvidia is a key customer to OpenAI. It's a key supplier of the chips, but it's also a financer of the OpenAI ecosystem. So there's all of these interlinks. And at the end of the day, we'll see the tech leadership play out over the course of the next 2 to 3 years to find out which of the ecosystems is going to be the dominant platform. And that's still unknown longer term. Yeah, just in another part of the ecosystem, Bloomberg's learned that SoftBank is in talks about a potential $10 to $20 billion bond offering to help refinance a loan in its investment in OpenAI, so another part of this chain. Surely these are massive sums when you've got concerns about credit risks that you're already flagging and concerns about whether these investments are actually going to pay off. That's right. We still don't know whether the classic return on investments, return on invested capital will come through or not. Now, what it appears from the article is that SoftBank are refinancing up to about half of the bridge loan they've had, so very expensive financing. I'm going to be really keen to watch what kind of rates they get on this refi, whether they can get good terms, because recently, as I say, we have seen increased prices. That we had the example of Alphabet in Australia paying the highest rate that we have seen for quite some time. So let's see what plays in terms of what they're actually going to get in terms of those loan rates. OK, looking forward to your analysis of the Nvidia results. That's Bloomberg's Neil Campling, thank you. Well, where sentiment is boosted today, one of the reasons why is because oil prices are falling for a third day as Iran and Oman look to push diplomatic efforts to resume shipping through the Strait of Hormuz. For more, let's bring in Bloomberg Horizons Middle East and Africa anchor Abir Abu Omar. Abir, just tell us what we know about how this framework for Hormuz could actually work. Good morning.
Good morning, Lizzie. Well, what we know about it so far is that it's a temporary mechanism to reopen the Strait of Hormuz for the coming period. Of course, the two countries are going to go into further discussions to find a more permanent solution to resuming the traffic or the movement of vessels stuck in the Strait of Hormuz over the coming 30 to 60 days. That's, of course, according to a joint statement by Oman and Iran. Some other clauses that were mentioned or that we know about, Lizzie, is that they will both find a mechanism or a way to demine or find a way to remove mines or clear them to restore safe navigation through the Strait of Hormuz. And then one other very important thing that was mentioned is that there's also going to be some discussions about who's going to manage the Strait of Hormuz. Now, we don't know how that's going to sit with the United States and definitely countries in the Persian Gulf. And speaking of the Persian Gulf, we also have reason to believe that the statement had alluded that maybe Gulf countries are going to participate in the wider agreement. But of course, for the time being, this is a temporary measure just to get that stuck traffic in the Strait of Hormuz that has been there over the past 2 months or so to get a move. We don't know how that's going to translate into reality. And of course, we await that more permanent solution. Now, when it comes to the demining, which is a big part in all of this, of course, because it is the part that poses physical danger, Lizzie, on the traffic. President Trump did come out and say multiple times that the Strait of Hormuz has been demined. Of course, he never gave evidence to that assertion. Iran and Oman now say that this will take place. Of course, that was a big concern for countries in Europe and countries here in the Middle East. But a positive breakthrough, although it doesn't say much, it is positive. And that's why you're seeing Brent crude prices down for a third straight day, about $85, $86 on the barrel.
OK, Abir, thank you very much. That's Bloomberg's Abir Abu Omar. Well, ECB member Isabel Schnabel says that interest rates must rise further as that lengthy conflict in the Middle East, as well as surprisingly strong Eurozone economy, the economy pose upside risks to inflation. I'm joined by Simon MacAdam now, Deputy Chief Global Economist at Capital Economics, for analysis. Good to have you, Simon. I don't know if you've seen this interview with Isabel Schnabel. Of course, she is a hawk on the Governing Council, but when you have an ECB hike in September almost fully priced, do we need to wait for 2027 for another one?
I don't think so. As you rightly say, Isabel Schnabel has been consistently on the hawkish end of the spectrum in the last couple of years, and particularly since the Iran conflict began. But in terms of the rate outlook for the ECB, I mean, let's look. It's true that the Eurozone economy has been resilient in the face of higher energy prices. But to some extent, the household savings have clearly acted as a buffer. We anticipated that to some degree. I think it surprised us and others as well, to the extent to which that has played out. But we're thinking about price pressures going forwards. There are next to no signs of indirect effects of the conflict feeding through. So you're going to have higher energy prices, obviously hitting consumers with higher fuel prices. Ultimately, that will feed through to higher electricity prices as well. But in terms of the indirect effects, things like how is higher fertiliser prices and how are fuel prices going to boost food inflation? To what extent is jet fuel prices passing through to airfares? Or to what extent are some of these power generation costs diffusing their way through the price mechanism? So far, there's very limited evidence of that. Now, it's true that some of these effects are lagged. They do take time to feed through. Food inflation, for example, can take as long as a year to fully feed through into consumer price inflation. But I think the magnitudes we're looking at and the limited evidence of these sort of indirect effects we've had so far suggests that price pressures are relatively contained. We've had some of the survey indicators have started to see some of these price indices fall a little as well. And the big thing that keeps central banks up at night is the risk of second-round effects. Is the labour market hot enough? Is the economy booming such that workers and firms respond to higher energy prices by trying to bid up wages in order to compensate themselves for a hit to their purchasing power? And I don't think there's very much evidence of that either.
But if you put the second round effects to one side, within energy, a nat gas price is more of a concern now for inflation than oil when it's the European picture.
That's right.
OK, right. So where's neutral for you?
Well, I mean, to be honest with you, we don't even necessarily think that they needed to have hiked already, right? Okay, we thought we've characterised initially when they hiked, we thought it would be a case of one and done. That would be all that's necessary. That was predicated on the view that we wouldn't get a sustained increase in natural gas prices, and it was predicated on a relatively optimistic view that seemed to be prevalent at the time of the signing of the Memorandum of Understanding, that we would get a gradual reopening of the Strait of Hormuz. That has obviously come into doubt, and the longer that this conflict goes on, the longer that the blockade is in place, the bigger the risks are to energy prices. Now, you mentioned that gas being more important than oil for Europe. Absolutely, that's the case, and we're seeing natural gas prices rise. Stocks are at a seasonably low level. They really should be much higher where they are, considering we're coming into peak demand season.
Heading into winter.
That's it. So I think the risk here is that you do get higher gas prices feeding higher electricity inflation and higher food inflation. The question is, what is the state of overall demand? Is there going to be, the question for 2027, is the Eurozone economy going to be strong enough to allow to convert those transitory price pressures into a more persistent price pressures to which the ECB would need to respond forcefully? And I'm not convinced that's the case. It's true that the rhetoric coming from some of the governing council members and the stance of the ECB generally, I would say, we could characterise their reaction function as hawkish. So there's the risk is clearly there's there being a one or two rate hikes. But my base case is that the economic fundamentals don't justify them.
Let's also talk about the US, because, of course, we've got PCE coming out later. How hawkishly skewed are the risks from that print?
Well, I mean, not really. I mean, the print for the PCE deflator is we've already had the CPI and the PPI data, so we're pretty nailed on for a sort of around target consistent, slightly higher than target consistent print for the core PCE deflator. So we're looking at about a 0.2 monthly gain. Now, that on itself, taken in context with the softer labour market data that we've had recently, taken into account some of the softer activity data as well, suggests it's sort of dampening some of the appetite for a sort of a September hike from the Fed.
OK, because the bets have been up and down when it comes to a September hike.
Yes, it's been a bit of a roller coaster, hasn't it? I think that we had initially ourselves, I thought the September hike was most likely outcome, but always contingent on the July and August data releases. And it just turns out that ever since we had the July FOMC meeting, things have sort of been playing into the dove's hands.
Well, partly because, of course, of Kevin Warsh's communications.
Well,
We're going to hear from the chairman on Friday at Jackson Hole. Do you think that he needs to give more clarity on the reaction function of the Fed and his views on inflation to restore credibility to the Fed? Or is Fed credibility just fine in your eyes?
It's a bit of both, really. In a sense, it's a storm in a teacup. And it's like the big commentary we all had about whether Fed independence was under threat from Trump. And a lot of column inches was devoted to it. I'm sure a lot of interviews on this programme were devoted to discussing that issue. And generally speaking, it doesn't amount to a huge amount. Similarly, with the credibility of the Fed being brought into question by a bit of a flop at a press conference from Kevin Warsh, it's probably overstated the significance of this.
So just a rocky start, maybe?
A rocky start, maybe, but I mean, what makes me only slightly marginally concerned is that, of course, it is a long-standing view of Kevin Warsh that he's not a fan of great transparency, and markets want transparency. So to the extent that he wants to manage market volatility, it makes sense for him to come out and try to give markets a little bit more in terms of what he's talking about, in terms of what inflation measures is he talking about when he's talking about inflation pressures more generally. We want to know, in the past when we were talking about inflation targets moving, that was a question of central banks potentially moving the goalposts. With Kevin Warsh, it's a question that there are multiple goalposts and we don't know which one he's shooting for. And it'd be really good if he gave some indication about that. The problem is, of course, Jackson Hole's theme is about financial innovation and about payment systems.
Want to hear about
could
necessarily.
Be a bit of a snooze fest, but there's a chance that probably a likelihood that he says something interesting.
But what about Scott Bessent's credibility, the Treasury Secretary wading into the bond market? You've been the voice of reason. Does he have a credibility problem, would you say? Because you've had the likes of Citadel saying that what he's doing is financial repression.
Oh, right, OK. So two things here. On that last point on financial repression, let's be clear, I don't believe he's doing financial repression at the moment. Potentially we're at the beginnings. So what he's actually doing is debt management, I would say. So this buybacks of issuing short-dated bonds to buy back long-dated bonds on such a small scale, I think is a relatively minor technical debt management issue. I think moving forward into Q4, they might even change the issuance such that they, again, skew it more to shorter-dated bonds, to bills. But I'd still classify that as debt management. When we're getting the Treasury and Trump coming out and demanding that US financial institutions have to start hoovering up more treasuries, or when they start talking about potential regulatory changes in order to force them to do so, that's when we're in a world of financial repression. So I don't think we're there yet, even though I do accept that we could look back in a year's time and say this was the beginning of a move towards financial repression. But I don't think we're there yet. The broader point you have about Bessent and a credibility problem, it comes back to the difficult, sticky situation that the US finds itself in the Middle East. And clearly Bessent has been put under pressure to have to come up with something. The military means has not been sufficient to bring about the change the Americans wanted in Iran. Therefore, the onus is having to be taken up by the Treasury Department and what they can do with economic warfare. The latest announcements about the economic D-Day really doesn't add very much to what's already in place. Iran is already heavily sanctioned. It's largely an economic pariah. It's under blockade and its exports are largely stopped. So further economic sanctions are, one, unlikely to put on much more economic pressure, and two, likely to run all sorts of problems with managing the relationship with China, with whom the Americans, of course, have a famous meeting, much anticipated meeting in just a month's time.
Exactly.
So I'd say it's less of a credibility problem. It's just sort of symptomatic of the wider geopolitical problem that America is dealing with in the Middle East.
All right, Simon, thank you so much. Simon MacAdam there, Deputy Chief Global Economist over at Capital Economics. Great to talk to you this morning. Well, coming up on the Pulse, the Trump administration weighs more trade measures against Canada after Prime Minister Mark Carney unveiled dollar-for-dollar retaliation against new US tariffs. We'll get you the details next. This is Bloomberg.
I told the Prime Minister, no deal is better than a bad deal. And we have to go tariff for tariff and dollar for dollar. And it's unfortunate. We had an attack from President Trump on our sovereignty, on our country, on the economy, that we're so integrated. Both countries were both each other's number one customer. And it just doesn't make sense to attack each other.
Ontario Premier Doug Ford there on Canada's response to new US tariffs. Well, let's bring in Brendan Murray, who leads Bloomberg's global trade coverage, for more. So where do things stand in this trade war, Brendan? What's in the US arsenal to reply to the retaliation from Canada?
Yeah, I mean, in the span of 48 hours, we've gone from the strident response, the insults, to really the silly stuff. The President Trump saying he wants to change the name of Lake Ontario to Lake America. And so we've sort of run the gamut of President Trump's calling cards here. And we've heard some noises from the Canadians that, you know, they're now facing the tariffs. They're paying the tariffs, and Canadian consumers and businesses are feeling the weight of that. And there seems to be some softening of the tone. Doug Ford, talking about how, look, we're each other's biggest customers. So this tells me that we're headed back to the negotiating table at some stage, whether it's in the next 2 weeks before Canada's tariffs take effect, or they kick the can down the road and they try to put something together before the end of the year. But the bottom line is neither country really can afford to go into a full-blown trade war. Remember, this is just a small segment of the trade that goes back and forth across the border. It's not going to have a huge economic impact. I think one of the estimates from a Canadian economist was 90,000 jobs are at stake in this current situation. Any job loss is not great, but 90,000 is not going to tank the Canadian economy. So both sides here have an incentive to get back to the negotiating table.
What have CEOs been saying then about the hit to business? Because we know that Carney's promised to try and make some damage limitation. Yeah,
exactly. So, the auto companies are the main ones that a lot of people are focused on. They have the most at stake, the supply chains that stretch across both countries. And, it's going to cost them. They're very careful to not say anything too publicly because they want to stay on the right side of President Trump. But what we're seeing in the Canadian media are the small businesses, the importers of American goods and the exporters who are already seeing the price tag of the things that they sell go up, and it's difficult to pass on big price tag increases when both countries are really facing kind of an affordability crisis, to use the political phrase from Washington.
Okay, Brendan, thank you very much. That's Bloomberg's Brendan Murray. Now, turning over to Bitcoin, because it surged 25% last week with the renewed chatter about the debasement trade, bringing it back into favour. Let's bring in Bloomberg senior crypto editor Ryan Weeks for more on this. So Ryan, how much can we attribute the rise in Bitcoin to Scott Bessent's buyback plans? Is this actually evidence that the debasement trade is back?
Well, it's certainly a big factor. Bitcoin was created with anti-inflationary properties in mind, to exist beyond the purview of government, and so Bessent's intervention was seen as, creating a favourable macro backdrop for Bitcoin, and that really played out last week. The weekly gain you mentioned was the biggest in percentage terms in 3 years, I think. We've seen ETF buyers, Bitcoin ETF buyers, come back in numbers. I think the inflows last week, again, were the strongest for something like 10 months. So certainly a big factor. Another was more regulatory in nature. So there was a meeting between Donald Trump and industry executives at which he, called for the Clarity Act, which is a market structure bill in the US, to be pushed ahead with after it had stalled recently. So that was another big driver for Bitcoin.
But everyone was saying, when you get past 80K, it's a psychological level. It's only going to go up from here. We're actually below that level now. So what do you think the next catalyst will be? Could it be Jackson Hole if we don't get much of a conclusive message from Kevin Warsh and you see dollar weakening off the back?
I mean, that could certainly further bolster the idea that this is a very favourable backdrop for Bitcoin. I think, again, the other near-term catalysts are regulatory in nature. The Clarity Act, any sign of progress on that would be looked on very favourably. The other potential driver is that Trump and the CFTC have signalled their intent to try to bring perpetuals, which is a trading instrument for crypto, the most popular in crypto, in fact, into the US, and to have regulated issuers of perps there. It's not so directly relevant to Bitcoin, but for the crypto market as a whole, that would be seen as a very bullish signal.
OK, Ryan, thank you very much. That's Bloomberg senior crypto editor Ryan Weeks. Now to some of the other stories we're following for you this morning. Bloomberg has learned that Huawei has pitched Egypt on building AI data centres for military surveillance and other public sector use. If successful, the project would mark early but meaningful progress for China's campaign to challenge American dominance in global AI infrastructure. We're told the Trump administration has approached Nvidia, AMD and Microsoft about assembling a US counteroffer. And the Queen of Country Music, Dolly Parton, has died in Nashville at the age of 80. She emerged from extreme poverty in rural Tennessee to become a renowned songwriter, singer, performer and businesswoman, known and loved for her one-liners, rhinestone-studded outfits and blonde wigs. Some of her most famous songs include Jolene and I Will Always Love You, which was also covered by Whitney Houston back in 1992. Good morning and welcome to The Pulse. I'm Lizzie Burnham in London and these are your top stories. Brent drops for a third consecutive day as Iran and Oman push ahead with talks on a temporary shipping corridor through the Strait of Hormuz. Bloomberg understands the US is considering even more tariffs on Canada, with the trade war threatening to spiral. And Nasdaq futures are lower ahead of results from AI bellwether Nvidia, the key macro event ahead of US inflation data and Jackson Hole. Well, staying with the AI trade, and Nvidia is expected to continue growing at breakneck speed when it reports later. Let's bring in Ven Ram from the Bloomberg MLive team for more. So Ven, we're talking to you about this because at this point, Nvidia's results are a macro event. It's got a macro market cap of $5 trillion. But you say that Europe's going to benefit no matter what the immediate fallout. Why?
Morning, Lizzie. I think that, the optimism on Europe is kind of well-founded because, if Nvidia does well, the outcome is going to be pretty binary regardless of the results. If Nvidia does well, then that is going to boost some of the technology and semiconductor names that are prevalent in Europe where there is scope for earnings compression. But if the results are bad, then Europe becomes a defensive play and a diversification asset because where else are investors going to chase yields, earnings yields? I mean, Asia is stretched, valuations are stretched for the same reasons as in the US, which is technology overladen. So Europe offers a safe diversification avenue for that, particularly in the UK, because, if you look at UK and the Euro Stocks 500, I think that the available earnings yield is north of 6%. That is not to be scoffed at. You won't get anywhere near those kind of pickup anywhere in the developed markets. Not only that, if you look at the historical PEs, the current PE in UK is well lower than the historical PE. So the markets are kind of undervalued. And if you look at the equity risk premiums, which is the excess in earnings yield over the 10-year yield, German yield, that is also pretty high in Europe and in the UK. So all in all, valuations look compelling, and if the theme of the markets is going to be rotational play, I think that the scope for earnings compression is the most likely in Europe.
Okay. I also want to get your take on the bond market this morning, Ven, because we were talking about all of the scepticism from Wall Street about Treasury Secretary Bessent's bond buying plans. And yet, are we actually seeing signs that the Bessent put's working?
It is working for the time being, as it is meant to work, because there were a lot of short positions on long-dated treasuries before Bessent's announcement of buyback. So I think that it is only natural that some of those short positions have been unwound. But the question is, the longer-term question remains. What is the Treasury's plan to cut the deficit, and what is the Fed's plan to cut inflation? And on neither of those fronts are we getting any kind of material development. Warsh, of course, is going to speak later this week. But what is he going to tell us about inflation that he isn't already said? We know that he sounds very hawkish on inflation, but is the Fed as a whole, as a committee, willing to act on that conviction and raise rates to get inflation to 2%? We are going to get the core PCE reading today, and that is going to show another reading of 3.3%. And somehow we have come to accept 3% as the kind of de facto normal. That itself says why treasuries are under pressure, and that pressure is going to continue.
Yeah, and surely it's going to get harder and harder for Kevin Warsh to sound hawkish as we get closer to the midterms if he misses the chance at Jackson Hole. Ven, thank you for the analysis. That's Ven Ram from our Bloomberg MLive team. Now, turning to Europe, and France is heading into a new season of political brinkmanship that'll test investors' patience with a showdown over the country's towering debt. We can get more now with Bloomberg's Caroline Conan. She joins us from Paris. Caroline, we've got yields at multi-decade highs around the world, but also in France. Parliament gridlocked. Budgets are always dramatic, as we know. You've covered many of them for us. But just how perilous could this last finance bill of Macron's presidency be in the context of his 10 years in power?
Of course, you have the global geopolitical uncertainties weighing on this bond market as well. But in France, you have this whole domestic uncertainty over the next few weeks and months. First, over the budget that needs to be passed by the end of December, with this very fragile Prime Minister, Sébastien Lecornu, who just 1 year ago actually decided to quit and then come back a few days later. So clearly, that's going to be again a showdown over the next few weeks. As you can see, the debt servicing costs of France have been surging with these high interest rates, and at the moment it's 65 billion euros of debt servicing costs for this year, could go up above 70 billion euros next year, and France hasn't really managed to cut properly the deficit over the past few years. In fact, last year's target was 5% of GDP, and this year for the next budget it's probably going to be a similar target, about 5% of GDP. So clearly very far away from the EU target. And just before an election, it's difficult to imagine that the Prime Minister, with this fragmented parliament into 3 blocks, is going to manage to really cut spending and really bring the deficit below this 5% threshold.
Well, yeah, when you look at the candidates in the French presidential elections, which are fast approaching, none of them seem to be promising to cut spending. So surely then French yields are only going to keep climbing.
And if you actually look at the two leading candidates in the poll, the far right Marine Le Pen and the far left Jean-Luc Mélenchon, the main risk that the markets are facing over the next few weeks and few months is a possible runoff, a second run in the presidential elections, with these two candidates of Jean-Luc Mélenchon and Marine Le Pen facing each other. Jean-Luc Mélenchon, who actually, as soon as this month, said that French debt needs to be put in the freezer. So basically asking the ECB to do some sort of haircut of French debt. Before that, he was saying that French debt should be actually sent to fire. So clearly not many big plans here to cut French debt and to cut the deficits. If you look at Marine Le Pen's plans, we don't have the details of the manifesto quite yet, but mainly she wants to cut France's contribution to the EU and to cut the welfare spending to immigrants. So not really structural reforms here in order to really bring this deficit down over the next few years. Edouard Philippe, one of the other leading candidates, is actually proposing a 10% reduction in state spending. So that's one of the proposals. And in fact, tomorrow night, we're going to have the MEDEF business lobby organizing a debate with 7 candidates facing CEOs of small and medium enterprises. So we'll see what the questions are. That may be actually an interesting debate to find out a bit more about the economic plans of these candidates.
OK, we'll look forward to your reporting on that then, Caroline. Thank you very much. That's Bloomberg's Caroline Connin in Paris. Well, of course, here in the UK, we also have a fiscal dilemma. Prime Minister Andy Burnham refusing to rule out tax rises in the autumn budget, saying that he, quote, won't be unrealistic about the state of the public finances. Joining us now to discuss what British businesses want to see in the budget is Anna Leach, Chief Economist at the Institute of Directors. Anna, great to have you round the desk. So when you're talking to British businesses that you represent, what sort of policies or reforms do they want from Team Burnham to keep operating in the UK?
Well, of course, I mean, you mentioned tax. What they would rather like is a tax cut. Certainly not.
Wouldn't we all?
Wouldn't we all, yeah. They certainly don't want any more tax rises. They would like tax simplification and certainty, because that's one of the key challenges they face. They want regulatory costs to come down. There is a target for that. That needs to be pursued as well. They want electricity costs to be brought down as well to make British business competitive again too. So these are many things that have been around for quite a while for businesses, and they're just getting a bit sharper.
You mentioned certainty. Is there a sense among your members that they're going to hold back on investment and spending until we know what comes out of the budget?
It rather depends on the sort of commentary trajectory from here, because at the moment, we're quite early on in the new Prime Minister's tenure. Speculation hasn't been massively high regarding tax changes in the budget, as you say, a little bit, and he's, ruled out discussing it, which is the right thing to do. So at this point, compared to the last 2 years, it's not the kind of environment which is where the politics is going to be a particular pressure on investment and hiring trends. The challenge is the broader environment applying pressure. We've got the Middle Eastern conflict persisting. We've got the ongoing sort of ratcheting up of employment rights and the implementation challenges that those represent for businesses. And those are the kind of pressures which are really sort of holding back some of those big spending decisions. OK,
so more about the external headwinds. But, when you look at Team Burnham and the fact that Jim O'Neill didn't want to be a part of it, he says because he's got other jobs to do and they're very exciting, he wants to concentrate on them. Does it knock your confidence in the administration when we know that Jim O'Neill would have been against, for example, wealth taxes and higher capital gains taxes?
I mean, it's difficult to read, isn't it? Because, of course, his position is understandable. He didn't want to be compromised in his sort of investment choices and broader positions, which is fair enough. But we also haven't had any more about, what might a formal advisory role look like for Richard Hughes. That would have been an interesting...
Former OBR chair, of course.
Indeed, which would have been an interesting person to have on board. And, of course, Andy Haldane as well, who's also got a BCC, British Chambers of Commerce, hat on as well. So brings a bit of the business acumen to the fore as well. There's been talk about his engagement with the new administration. So, I mean, that feels a little bit... that's a little bit hard to read. And I think elsewhere in what's coming out of Burnham and friends is a little bit hard to read as well. Because on the one hand, the devolution agenda and some of the more boring but important behind the scenes administrative changes. So number 10 North, but also, reframing the Cabinet Office and sort of rebuilding the connections surrounding that to enhance implementation. That all looks quite good for growth.
Looks good. Okay, yes. So it's not just, moving the deck chairs on the Titanic. It's actually going to materially move the needle for economic growth in the UK.
It could, because what they've been doing is, so this machinery of government changes, so hence I describe it as kind of dull. It's not the headline rebrand that number 10 North is. It's the stuff that actually matters. So how do we actually connect up the right policy, powers, levers and competencies behind the scenes to enable devolution to be delivered effectively? So what's happened is some powers have been taken from Treasury and MHCLG in relation to devolved economic policy authority.
Yeah.
Cabinet Office has been reshaped. There's this new National Economic Council, I think it's called, has been recreated with mayors on board to try and bring together all the right parts of the growth.
But does that growth come fast enough for the next election in 2029?
This is the challenge, right? So it's all the right stuff. That's part of the challenge, really, right? Is like everything that is good for growth and the UK needs to do delivers relatively slowly. And we don't have huge amounts of money to spend either. So, this is the big problem. It's a lot of slow, hard, disciplined work, like cost of living. Actually, it's not easy to solve. We don't have loads of money to alleviate the pressures on budgets.
But the good thing is, when you look at the data lately, the PMIs, the confidence numbers, actually they're pretty rosy. So do you think that this kind of boosterish tone from Burnham actually has a material economic impact, unlike what we saw with the Starmer administration's debut and the gloomy tone from Starmer and Reeves?
Absolutely, because actually what we saw with Starmer and Reeves and the run-up to the two budgets, it did have a deleterious effect on growth. The OBR highlighted it, actually, in their last budget assessment, that they thought it had led to weaker economic growth in the second half of last year. So, of course, yes, having a clearer communication strategy and being a bit more upbeat is likely to have a little bit of a boost for economic growth. And yes, you're right, there's been some positive upside surprises on economic growth. Inflation isn't dreadful, given what's going on in the Middle East. The challenge, of course, is that the labour market is still weak, inflation is going to rise further, that's going to compromise real household income growth. So you've still got these sort of broader economic pressures which are going to be continuing to constrain things and keep growth around that rather limp 1% rate.
Well, we've seen such dissent on the Bank of England. How do you see the path ahead forming when, as you say, there is that debate about whether the labour market's weak enough to keep a lid on inflation?
Yeah, well, the two things they're looking at, as we know, is what's going to happen with wages and what's going to happen with price setting by companies. So the labour market, all the reads on the labour market look fairly subdued. Vacancies are continuing to fall. Wage growth is coming down relatively in line with expectations. So the labour market side, it looks like that's not going to be a major source of inflationary pressure for the Bank of England to be concerned about. The interesting thing will be, if we've got this sort of reinvigorated confidence and economic buoyancy, does that create conditions in which firms are more able to pass on price rises? So does that create an additional source of inflationary pressures? Meanwhile, we suspect that food price inflation is going to become higher still later in the year. It's expected to go up anyway because fertiliser costs, etc., have pushed up. But now we've had, worst harvest probably on record in the UK, and harvest impacts across Europe as well. So that's going to have an inflationary impact. And we know that's the measure that consumers look at and worry about. So it's still a bit complicated, but at least it's nice to have a bit of better news recently.
Isn't it indeed? Anna, thank you very much. That's Anna Leach, Chief Economist at the Institute of Directors, with the business view on what's happening in the UK economy. Well, coming up, Banco BPM is signalling scepticism over Monty Paschi's takeover offer. So we'll get more on the M&A next. This is Bloomberg. This is The Pulse. I'm Lizzie Burden in London. Now, OpenAI says its new in-house chip outperformed Nvidia's current flagship processor in key tests measuring efficiency and response speed. Chip chief Richard Ho told us exclusively that the goal is to deliver more intelligence to users at lower costs.
The benchmarks that we did were with an open source kind of benchmark called Inference X. And we did that because it was a fair, kind of neutral benchmarking method. What we're seeing with Jalapeño is that we're able to get both high throughput and low latency with the same device, which is a kind of a first in the industry. And why does this matter? Is because high throughput means that you can serve a lot of customers with a lot of tokens much cheaper than you could if you otherwise. Low latency gives you very fast response times. And so, the agents will come back faster, you can do, more coding quicker, and that really, I think, is a real benefit for our products.
This is it. This is Jalapeño. You very graciously allowed me to get my hands on it. And again, the whole emphasis is on throughput and ultra-low latency. This is an inference chip.
It is.
So very simply, why focus on inference, not on the training side with your custom silicon program?
Well, I think that if you look at it, right, OpenAI has this enormous need of compute. And where that growth of compute is really on the inference side. We need a lot of training, and we have a really strong partner in Nvidia who has, really got a great training chip. So we focused on where we thought we needed to increase the amount of compute that OpenAI has available. With the growth in our users, with our weekly active users growing very, very fast, we saw the need to continue to have a wide range of inference products, and this is going to be part of our fleet along with our existing partners who are providing us other chips.
How do you decide which workload goes to Jalapeño versus Nvidia or Cerebras, for example? You have options, but how do you make that decision?
It's a great question, right? I think with this optionality that we're now creating for the company, I think that we will be able to provide users with a range of models that have different cost benefits and different latency capabilities. We will map that ourselves. We will map out which product, which SKU, which chip is best for which one of these models. But the whole goal of this is to deliver more intelligence to our users at a lower inference cost, at a lower infrastructure cost. And that's what this is part of, that entire strategy that we've been working on for a while now, right?
Lots of people struggle with the benchmarks. To the layperson, it's difficult to decipher. So in very simple terms, on a dollar per token basis, how does Jalapeño stack up against the other options that are out there? How has this changed the economics for you?
It should drop it. It's a really good chip. It should drop it by a lot. The performance per watt that we're seeing, which is a good proxy for how much token will cost, is somewhere in the region between 1.8 to 4x better than other existing chips right now. And so we should see that ultimately when this rolls out into production, customer token prices should come down. That's a big drive that we've had at OpenAI for a little while now. And this really is part of that strategy.
OpenAI chip chief Richard Ho speaking exclusively to Bloomberg tech anchor Ed Ludlow in San Francisco. Now let us turn to Italian banking M&A, and in the latest news from the acquisition saga, Banco BPM has indicated scepticism towards the takeover offer it received from rival banker Monte dei Paschi. The lender's board acknowledged the unsolicited offer, but said that the bid does not recognise a premium for its shareholders. Let's get more on the saga with Tommaso Ebhardt, Bloomberg's Southern Europe managing editor out of Milan. Tommy, we all knew it was going to be a tall order to get this over the line, let alone at the same time as buying Banca Generali. But is Paschi's plan looking like a non-starter at this point?
Ciao Lisi, buongiorno. It's an ambitious plan. We heard last night the initial response by Banco BPM, who had been talking for a combination with Monte dei Paschi for months, if not years, until they stopped a few weeks ago. And the board said, this is unsolicited and there's no premium for us, so it doesn't look they appreciate it. But at the end of the day, it will be a matter of shareholders' vote. So which are the next steps? First of all, 29th of October, Banca Monte dei Paschi di Siena shareholders needs to approve the twin bids for Banco BPM and for Banca Generali, and then the offer will go to the shareholder of those two banks. In the meantime, Intesa Sanpaolo, Italy's biggest bank with UniCredit, is going ahead with this bid for Banca Monte dei Paschi di Siena. And if you want to add some complexity, the Italian government, which still owns a share of Banca Monte dei Paschi, had decided to hold off to a sale of its remaining stake in Monte dei Paschi, not to interfere in this incredible saga about Italian banking.
So even more hurdles to come then. Do you get a sense that Paschi investors will be on board at the meeting?
That's a good question. CEO Lovaglio needs 2/3 of investors to approve his plan, because Monte dei Paschi is under so-called passivity rule, because he's under Intesa bid. It's not going to be easy. He needs the approval of some of its main backers, which include, for example, the Del Vecchio family, the billionaire family which funded EssilorLuxottica, is the biggest investor in Banca Monte dei Paschi di Siena. But that family itself is facing a very difficult succession issue. 4 years after Del Vecchio died, they haven't agreed on the succession, and the news of yesterday is that one of the heirs resigned from EssilorLuxottica. Are they going to support Lovaglio? Are they going to give the share to Intesa? It's a big question. We don't have an answer so far. We'll try to find something for you in the next days, weeks, or months.
All right, I'll hold you to it, Tommy. Thank you very much. That's Bloomberg's Tommaso Ebhardt in Milan. Well, let's check in on these markets as we wrap up the hour. And we have been seeing Brent there weaker by 3% now on the latest in the Middle East, $85 a barrel on Brent. It's not doing that much to support equities. We've got Nasdaq futures lower by 0.2% as we head towards those Nvidia numbers after the bell. Here in Europe, the Stock 600 is only flat to the upside. Euro dollar pretty steady, despite the hawkish comments from Isabel Schnabel saying there must be a hike from the ECB. So 116 is where we trade on euro dollar, and Bitcoin still below the 80k level. But maybe we'll get another leg higher later on in the week when Jackson Hole comes. That does it for the Pulse. Bloomberg Brief is up next. We'll pass you from London to New York. Good morning. This is Bloomberg.